The coupon is folded twice. You've been carrying it for 11 days. 20% off groceries, minimum purchase of $30, meaning you have to spend $30 to save $6. You've done the math. You've been doing the math since you woke up. This is what zero feels like. Not dramatic, just arithmetic, running underneath everything, every hour, all the time. Your checking account is negative $23. Not because you were reckless. A subscription charged 3 days earlier than you expected, and your paycheck hits Friday, not Thursday. The gap is 72 hours. The cost of those 72 hours is a $35 overdraft fee, which means you now owe the bank $58 just to get back to zero. You're not behind on rent, not behind on anything, technically, but technically is carrying a lot of weight in that sentence. The tire on your car has been slow leaking for 3 weeks. You add air at the gas station on Tuesday mornings, free with a purchase, so you buy a coffee you don't always want. $2.09. The alternative is a new tire. So, coffee. The bank processed the overdraft without telling you. You found out at 6:47 in the morning on the app. No message, no flag, no call, just a number with a minus sign that wasn't there yesterday. You call in. Wait 19 minutes. A voice reads a script. Fees cannot be reversed at this time. You ask about the waiver policy you read about online. Pause. Turns out you already used that option 14 months ago. You didn't know there was a timer on it. You go into the branch. The teller smiles at the person ahead of you, asks about their weekend. When you step up, the smile goes professional, polished, functional. The whole thing takes 40 seconds. She doesn't ask if there's anything else. The person behind you is already being greeted before you reach the door. You weren't insulted, you weren't refused, you were processed. Here's what nobody tells you at this level. The bank isn't being cruel. The bank is being efficient. You're a small negative number in a system that runs millions of accounts. The overdraft fee isn't personal, it's automated. A rule that fires when a balance crosses zero, regardless of why, regardless of how close Friday is, regardless of whether 72 hours would have fixed the whole thing. The system doesn't read context. It reads balance. And your balance said you were a cost to recover. There's a calculation running underneath everything at this level. Not anxiety exactly, more like a second language you learned early enough that you don't notice you're speaking it anymore. Every number converts automatically. That's 3 hours of work, 1 shift, 2. You calculate tips before you realize you've done it. You say you're not hungry when you are because someone might suggest splitting the bill evenly, and splitting evenly would cost you more than what you actually ate. At zero, the system doesn't punish you for failing. It charges you for it. The account doesn't have a minus sign anymore. It has $8,412. You check it more than you need to, not from anxiety this time, from something closer to disbelief. You paid off the smallest credit card, $640. You took a screenshot of the zero balance and sent it to nobody because nobody would get exactly why it meant what it meant. The car tire is replaced. $312. You drove away without immediately opening the app to check the damage. That pause, the gap between spending money and bracing for what it did to the number, that's gone now. The pause was always fear. No pause means no fear. That's new. Here's what the bank is doing with your $8,400 right now. They're lending it out at rates between 7 and 24% depending on the product. You're earning 0.01%. The gap between what they pay you and what they make from your money isn't an accident. It's the whole business model. Your deposit is partially funding a car loan for someone you'll never meet, at an interest rate 40 times higher than what you're getting. This is legal. This is normal. And it works this way at every level. The difference is that higher up, you eventually get to sit on the earning side of that gap. Then the credit card offer shows up. A secured card, meaning you have to deposit $300 of your own money as collateral so the bank can lend it back to you at 22% APR. Read that again. They want your money to lend your money back to you and charge you for it. This product exists specifically for people who need credit but have no credit history. It's also one of the most expensive borrowing options the banking system legally offers. It's aimed at the people who can least afford the cost and have nowhere else to go. You skip it. Which means when the car needs something serious, there's no buffer. The tire was $312. A transmission is 3 months of savings. The machine takes your deposits without acknowledging them. It doesn't know what 8,400 means to you. It just processes the number like it processes every number. The first $10,000 doesn't change your life. It changes your evidence. Evidence that you can actually build something. Evidence that direction is something you choose and not something handed to you. That evidence is worth more than the number itself. But what happens at 60,000 is something the bank does that looks like a reward. It isn't. It's a calculation. You have a 1-bedroom apartment, your name on the lease. A Roth IRA you've been contributing to for 2 years. A brokerage account with $41,000 in a total market index fund. 0.03% expense ratio. A number you found at 11 p.m. on a forum and acted on the next morning. Income is $68,000 a year. Take home is $4,300 a month. You save $900. The math works and has been working for 22 months straight. Then the bank makes a move you didn't ask for. Your credit limit jumps automatically from $3,000 to $8,500. The monthly fee on your checking account disappears. A banker calls to introduce himself, wants to schedule 15 minutes. Here's what actually happened. The bank's algorithm scanned your account pattern. Direct deposit, consistent, no overdrafts in 22 months. Credit card paid in full every cycle. The system reclassified you, not as a valued customer, but as a viable revenue target. The credit limit increase isn't a reward for good behavior. It's the bank deciding you're stable enough to carry more debt without defaulting. More rope. Not because they trust you, because the risk model says you'll probably pay it back, and the interest on $8,500 at 22% generates more revenue than the interest on $3,000. The smile is a signal, just not the one you think it is. You take the call with Calvin. He mentions a high-yield savings product. You ask about the expense ratio on the index fund you're already in. There's a pause. He says he'll send some information. The information never arrives. One night you run a projection, 40 years at your current savings rate, current income, historical market returns. You type in the numbers and the result comes back and it's fine. Comfortable. Survivable into a conventional retirement, not what you want. This is the plateau that doesn't have a name until you're standing in it. You can see clearly in both directions. Behind you, the overdraft fee, the coupon, 19 minutes on hold, the 40-second interaction that ended without a goodbye. Ahead of you, a number that works, but doesn't accelerate. 60,000 in net worth is real. It's also exactly the vantage point where the math of salary-only accumulation becomes visible for the first time. And the math is slower than you thought. From the outside, discipline at 60,000 looks like sacrifice. What they're actually watching is someone who changed what they're optimizing for. The conversation you'll have at 250,000 isn't just better than what you've been offered. It's a different conversation entirely. And it happens because of a number most people never know to track. You have a brokerage account at 161,000. A duplex in a secondary market 3 hours away with 38,000 in equity. A business. Something that started on weekends that you refused to call a business for the first 14 months, pulling in $3,400 a month. You're driving the same car you drove at 60,000. Not because you can't afford different, because you understand now that the car is not the investment. When you financed the duplex, your mortgage rate was 5.9%. Your neighbor, same income bracket, same city, same year, got 6.8. The difference was your credit profile, your documented rental income, and a 35-minute conversation with a broker who knew how to position the application. 1% across 30 years is not a rounding error. It's tens of thousands of dollars. And nobody in the system is required to tell you that gap exists or how to close it. You found the broker through a landlord forum at midnight. Most people never find the forum. Here's what the system is doing at this level that it wasn't doing before. It's competing for you. Quietly. A pre-approval letter shows up from a private lender, not standard direct mail. A different banker calls, not Calvin, and the conversation runs differently. He asks about your goals before mentioning any products. A wealth management consultation is offered at no cost. None of this is warmth. All of it is a calculation. Your profile now generates enough projected revenue to justify the cost of reaching out. You've crossed a threshold that triggers a different category of attention. The attention is real. The reason behind it is commercial. You say no more than you used to. To the group trip, where costs split evenly regardless of who ate what. To the investment pitched by a friend who uses the word opportunity as a substitute for research. To the weekend that would cost you the hours your business needs right now. The friction in the relationships is real. You feel it and make the call anyway. Not because the relationships don't matter. Because there's something being built that needs protecting. And the protecting looks like distance from the outside. The net monthly cash flow from the duplex, after insurance, taxes, and a 10% maintenance reserve, is $614. It's not passive. You answer calls. You filed a claim when the upstairs unit needed a water heater. You drove out on a Saturday to meet the contractor. But the math runs whether you're watching it or not. That's the shift. Not the amount. The running. Below 250,000, you're building towards something. Above it, you start to feel the thing building back. The brokerage updates on a Tuesday morning. $1,042,000. You sit with it for exactly as long as it takes your coffee to cool enough to drink. Then you open the allocation spreadsheet and start the rebalancing calculation. The milestone arrives. The work continues like the milestone wasn't there. Something opens that wasn't open before. Not because the world changed, because a threshold was crossed, and thresholds in the financial system are real structural boundaries with specific rules attached. You're now an accredited investor under SEC definitions. This isn't a title, it's a gate. On the other side are investment vehicles that aren't listed on any public exchange, aren't advertised anywhere, and aren't accessible to anyone below the threshold, regardless of how badly they want in. A private equity co-investment comes through your advisor. $50,000 minimum, 5-year lockup, projected IRR of 18 to 22%. You read the offering documents over 2 evenings. The waterfall structure, the 2 and 20 fee arrangement, how it correlates with your existing positions, you wire the $50,000. No hesitation. Not from confidence, from preparation. You've been reading toward this moment for 4 years. The bank that once charged you $35 for a negative $4 balance now sends a private banker named Thomas. He schedules calls on your timeline. He reverses fees before you notice them. He mentions mortgage rates that aren't posted anywhere publicly. Rates that only exist in conversations between the bank and clients at your tier. Same institution, different tier. Rules that were always there, applying differently at different thresholds, invisible from below. The identity question shows up here. Not do I have enough? That question is gone. The question is, what was this actually for? You thought the million would feel like a rival. It feels like a cleared table. The work that filled the space of getting here has been removed. And what's left is a question about what to put in its place. Some people answer that question. Some people work straight past it without answering, and the not answering becomes its own kind of answer. The millionaire who expected to feel different understands something the aspiring millionaire doesn't. The number was never the destination. It was proof that the system you built actually works. What you build with a working system? That's the real question. And what you'll find at 4 million is that the system doesn't just serve you differently. It starts coming to you. You have a portfolio. Not a savings account with a large balance, a portfolio with positions across 5 asset classes, each with a defined role. Private credit for income, equities for growth, real estate for appreciation and depreciation offsets. Cash equivalent instruments held as dry powder. $4 million without architecture is just a number. With architecture, it becomes a structure that runs. Your effective tax rate last year was 9.2% on income that should have produced a rate more than double that. It took 6 weeks and 3 professionals to design correctly. Every piece is legal, every piece is documented, and none of it, not the opportunity zone investment, not the charitable remainder trust structure, not the stepped-up basis planning, is available to anyone who doesn't know it exists and doesn't have the capital to make it worth building. The tax code isn't a flat surface, it's tiered, and the terrain is only visible from certain elevations. The bank stops asking you to go anywhere. Someone from the private banking team schedules a time to come to you. She brings a printed portfolio summary in a leather folder, asks about your estate planning timeline, your philanthropic intentions, your kids' educational structure. She doesn't try to sell you anything in this meeting. The selling already happened before she walked in. The moment your name crossed a threshold in the system's tier model and someone got assigned to the relationship. This meeting is maintenance. You are the asset being maintained. You've stopped trying to explain your financial situation to people who ask. Not because you're hiding anything. Because explaining it accurately requires vocabulary the conversation doesn't have. The tax structure alone takes 12 minutes to walk through correctly. You tried once at a dinner. Watch the expression shift, not judgment, just distance. The same expression you used to have looking up from a grocery store parking lot at someone whose life you couldn't quite see into. Now someone's looking at you that way. You recognize both sides of it. That's lonelier than only knowing one. The gap has been widening slowly enough that you didn't notice until you looked back. At 4 million your problems change names. Not easier, just unrecognizable from 3 levels down. The vocabulary doesn't translate, and you've stopped trying to translate it. You hold stakes in 7 companies, 2 are performing above projection. 1 is restructuring, you're watching the cap table weekly. The other 4 are in various stages that'll clarify over the next 18 months. You think in 18-month windows now. Not quarters. Cycles. The patience at this level isn't a personality trait, it's a strategy. Short windows produce noise. 18 months produces signal. The conference room where you take your most significant meetings has no name on the door. The table is a single slab of walnut, no joint, no seam, no logo on the wall. Rooms like this don't advertise. They exist because everyone using them already knows where they are. The deals here are introduced, not listed, not advertised. Introduced through relationships that took years to build, through pattern recognition that came from being consistently right, through a reputation that walks into rooms before you do. A sovereign wealth fund is co-investing alongside your vehicle on an infrastructure position. A private equity firm brought you in as a co-general partner, not as a capital source, as a co-GP. That distinction matters. A capital source provides money. A co-GP shapes the strategy. You are shaping the strategy. That's a different kind of participation than anything available at any earlier level. The institution now consults you. The head of private banking flew in last quarter, not to pitch anything, to listen. He asked what you expect from the next cycle. He was positioning the bank around your positioning. You are not a customer in that building anymore. You are a relationship the institution organizes itself around. A company in your portfolio announces workforce reductions. 120 people. You know the CFO had coffee with him twice. You don't call about the cuts. You review the margin trajectory. You hold, the position improves, you don't feel good about it or bad about it for long. What you feel is the distance, the thing that grows quietly as the numbers grow. The gap between a decision and its human consequences is wide enough now that the consequences don't travel back directly. You've stopped pretending that isn't true. Pretending costs energy. Energy is the only currency that doesn't compound. Above 25 million, the system no longer evaluates you. You evaluate the system. The exact figure is known to 4 people. You are one of them. You haven't said your net worth out loud in several years, not for modesty, because the number has become administrative. It describes a structure, not a person. A trust that will outlive you. A foundation that distributes 5% annually and retains 2%, the 2% folding back into principal, growing indefinitely. A family office managing capital across 14 positions in 11 markets. You are 63 years old. You haven't worked a conventional day in 8 years. You haven't stopped working. You don't wait on anything. Not for approvals, not for access, not for meetings to be arranged. Waiting is something the system applies to people. It still needs to evaluate. It evaluated you a long time ago. The wire transfer that takes 3 business days for a level 1 account processes same day for yours. The investment minimum posted on the institution's website doesn't apply to your account. The rate on any lending instrument you'd consider gets negotiated on a phone call, not submitted through an application portal. This isn't special treatment in the way that phrase usually gets used. It's the output of a tier structure that has always existed, has always applied different rules at different thresholds, and has always been invisible from the levels below. The system wasn't hiding it. It just didn't post it anywhere that people who hadn't crossed the threshold could read it. 2 calls today. One from a sovereign wealth fund in the Gulf. $7 billion seeking deployment. 3 firms being considered for the anchor relationship. Decision in the next 60 days. The second from a former finance minister, not a politician, a minister. You take both calls from the same room. 44th floor, corner. No trading screens, no data terminals, just glass and a silence that comes from not needing anything the room doesn't already have. You're not watching the market anymore. Your positioning is in the market. When you deploy capital, people note the direction. When you hold, analysts write about what the holding implies. You didn't seek this. It's the structural output of capital at sufficient concentration. Influence at this scale isn't personal, it's gravitational. The isolation isn't loneliness. That distinction took years to actually get. Loneliness is the absence of people. What you have is the absence of translation. The people you care about are good people living in a different context. The things that occupy your attention, fund structure, regulatory positioning, the dynasty trust question still being worked through, the liquidity event in your 3rd largest position, exist in a language that doesn't cross dinner tables. You're not a different person. You're a person whose context has become untranslatable to most of the people who knew you before. You give more than you ever have. Not for access, though you understand that's part of what it produces. You give because at this level, money has stopped being a measure of anything meaningful about you. And giving is one of the few things left that still requires an actual decision, where the deciding still feels like something. Most things at this level run on frameworks you built years ago. The frameworks are doing the work. The machine doesn't need you watching it to keep running. It never did. Above 50 million, the machine no longer needs you to operate it. You need you. That's a different problem than any of the ones that came before. And it's the one nobody prepares you for, because nobody who has it is in the room where the preparation happens. Somewhere right now, someone is standing in a grocery store parking lot. Coupon in their wallet, folded twice, 20% off. Minimum purchase $30. They've been carrying it for 11 days. They're doing the math. Not out loud, in that second language they learned young enough that they don't know they're speaking it. They don't know yet that the coupon isn't the story. The math isn't the story. What happens to a person across the distance between that parking lot and a room with no name on the door? What it costs, what it takes out of you, what it quietly builds in and quietly removes. That's the story. And it doesn't resolve. The system doesn't close. The machine opens every morning and processes whoever shows up. Somewhere tonight, the balance is negative $23. It always starts there. For someone, right now it always will.